Hi guys, welcome back. My name's Aaron. This is Czar Finance, episode 43, Understanding the MACD in Technical Analysis. Alright guys, well this is my first time doing this for the MACD and I'm going to try to do my best for you as best as I know it. Alright, so when it comes to the MACD, and the MACD actually stands for Moving Average Convergence Divergence. Okay, so the moving average of convergence divergence, where these two lines that are down here, which you can find by going to your indicators, and once you go to your indicators, you can actually see it under favorites, or you can search for MACD, and it'll be right here, and it'll pop up using down here in your indicator. I'm using TradingView, which is a free platform online. It's called TradingView.com. You can take a look at that. Find me online. My screen name is Alczar, A-L-C-Z-A-R. Again, my screen name is Alczar, A-L-C-Z-A-R. And again, I have the MACD showing here on the S&P 500 here. So this is moving average convergence divergence. It shows a 12 EMA estimated exponential moving average. It's not estimated, but it's a exponential moving average. And it shows a 12-day, 26, and then the signal line of 9. So what this is doing is here is taking the 12-day moving average and subtracting it from the 26 and then basically using it as a signal indicator for the 9-day moving average, which is smoothing it out. So the 9 here is in this case, is my signal indicator, which is my yellow line here, as you can see. Now, what happens with the MACD is as the stocks are going up and down, and this is a weekly view, as you can see in the top left-hand corner, this is my weekly view. Um, the line is going to be crossing this area down here. You have a zero line here, which is basically your ground fault, and anything above this line from 0 to 50 basically is going to be or 40 is going to be your positive territory for when the stock markets are going up and doing well. Anything below this line is going to be when the stock markets are doing poorly and they're going downwards. And at the zero line, it's kind of neutral. It's like just nothing's really happening. The market's just going sideways, etc. So what the big thing is a lot of people do is they look at the moving averages here for the MACD, and they try to look at the signal line and try to see where is crisscrossing, and then they can buy in certain areas here. So, for example, in this area down here, if you were looking at this signal area, you can see that the MACD is uh, is signaling here that it's going to be crossing over. So usually most people tend to look at this as an area to buy in. And the further the lines are apart from each other, the better the territory is, the more volume you have. See how these are called histograms, these lines right here, these pink lines? This is the histogram, which is basically the spread between these two lines. Okay, that's all it's telling you is the spread between these two lines. The greater the spread, the more volume you have, the more potentially of a positive bounce in either direction, above the line or below the line you'll have. So usually when there's a big crisscross like this, most people want to buy at this signal right here where the crisscross is, which is indicating right about here, and you can buy here in the S&P 500 example, and it's going to go up in territory. Now, as it goes up, it's going to be a wide gap, right, as you can see here, which is a positive indicator, which is a lot of volume using the histograms, the pink lines. And then you'll see as the lines start to come together, converge together, they almost hit here, which is basically chopping through here. You can see they're kind of chopping around. And then they got a little bit more volume, popped up again, and then they're coming down again. But then you see here that there's a crisscross here. This was a big sell-off point right here. So it sold off, it dropped down. Notice the signal indicators drop down below here. The histogram showed there's not a lot of volume. So this is going to start to drop down in this indication. Again, we're still in positive territory right here, and we're still spreading up top. We're bouncing across here, and the trend lines, or the channel lines, as you can see in these two blue indicator lines that are up here, this is going up, this is going up, and the stock market is rallying, and it's going back and forth, and it's trending up, it's bouncing off these lines. We'll see where it heads into the new year for 2017, but right now we are in an uptrend and for the new market. So hopefully this helps explain to you what a MACD is. Moving average convergence, which is two lines coming together, okay, and then divergence, where two lines are separating apart from one another using the histogram. And it's basically using these indicators, the 12-day moving average, okay, the exponential moving average minus the 26-day, which is going to give you the 9-day. Of the signal indicator smooths out the lines, and where those two converge and diverge, a lot of people can tend to use those to customize their way of getting in the market and getting out of the market. Now, I wouldn't rely extremely on MACD. It's a great indicator. It's very, very popular. You can use it on just about any stocks you want to use. So take a look at that. It's a great way. See how it works for you guys. If you start to see that there's a trend going on here in the positive territory or in the negative territory or below the zero line here, take a look at that. See if you place some virtual bets online, and hopefully that helps you out with explaining what the MACD is. It's a very good indicator to take a look at for beginners, and so it's a great way to do that. So again, on TradingView.com, you can go to indicators, type it in the search bar, and you'll see the MACD that's right here, and you'll see that pop up here as a default right here. I hope this helps. My name's Aaron. Thanks for watching. This is Czar Finance, episode 43, the MACD. Take care. Bye-bye.